Hi everyone, it's Frank speaking to you. It says here on Monday, February 18th, but actually that's not quite correct. It's still Sunday where I am as I'm speaking to you, Sunday, February 17th, 2008. Recording this latest installment hot on the heels of the exposition from Thursday last week of the so-called Four Sisters trade. And I was pleasantly surprised, relatively speaking, how much email response I got to it. This good, well, it wasn't quite 10, but it was certainly a good handful of emails coming back. People kind of interested in this trade. So obviously I've touched on something to address a need here, which is great. So I don't know if I'm going to get the chance to actually do any trading this week. I'm working on a couple of very I don't know what other word to describe it other than big projects for Forex Mentor, and I can't really talk about them at this point because they're still in development, but I need to get those progressing a little bit. So if I have some time for trade examples later in the week, I'll try and finally get caught up on what I owe you, the missing installment from the week before last, where I couldn't unfortunately find the time to do one of these. So I hope you had a great weekend, and like I say, this is going to be mostly oriented towards kind of a part 2 or some additional information on that trading system we talked about Thursday of last week. By the way, given that it is February the 18th by the time you see this, I guess to all my American friends I should say Happy President's Day. I believe that's a federal holiday in the United States. Here in Canada, we don't have a President's Day because, well, heck, we don't have a president. We only have a prime minister. It's our equivalent of a president, I suppose, but we don't take a day off to celebrate those folks, that's for sure. Anyways, happy President's Day, and however you choose to observe it, at least it's a day off, which is always nice. Today's agenda. I want to touch base on this concept that's been floated previously, the live trading room idea, getting some email inquiries about that. And like I say, with this Four Sisters trade, there's 4 kind of follow-on topics I wanted to address here to help you maximize your opportunities with it, if you so choose. First of all, how to replicate SMI on your chart if you do not have access to the SMI indicator in whatever charting platform you use. Also, since this is a course on MACD, it kind of seems appropriate to see how we can use MACD within this trading system, and there is an opportunity to do that. We'll look at that. I want to touch on a couple of filters we can use. We said last week that the system is fairly mechanical. You know, you identify the trend, you find a dip, you find a rally, you jump on it, fairly straightforward. Right? Well, usually, yeah, right. But sometimes there are going to be conditions which invalidate the setup. In other words, you have what looks like a bona fide trade, and only to find out in certain wrong types of conditions that you could get stopped out. And I just want to address these with you. Additional things you can do, additional precautions you can take to maximize your probability have a fairly bankable trade. So the first thing we're going to look at, the first type of filter, is to validate your entry signal with respect to indicator readings on the next higher level time frame. And the version of this Four Sisters trade we looked at last week takes place primarily on the 3-minute chart. So I'm generically referring to the next higher level time frame as the 15-minute. Now we also said that this trade, theoretically, you can use it on just about any time frame you want. So if you're working with it on a 15-minute time frame, then the next higher level signal is going to be found either on a 30-minute chart or a 60-minute chart typically. I'm sure there's some charting platforms out there, maybe eSignal or something, where you could get a 45-minute chart if you wanted to, but generically speaking, that's kind of the next higher time frame. So we're going to look at that, and then we're also going to look at another very important filter, swing points and Fibonacci. And so what I'm talking about there is how to identify a market that's retracing, even though the Four Sisters trend following indication is, it's still viable. Sometimes price can snap against you, so if you're taking a bona fide entry signal in that kind of environment, you have to be very careful. So those are, that's just in a nutshell what I'm going to go over here. I think I can dash off the first item there pretty quickly. Live trading room. What we're referring there to, again, is, and I don't even remember this when we did this, but probably a month or 2 months ago, I just kind of ran this idea up the flagpole, so to speak, of whether you guys would have any interest in taking the next step with this weekly chart of the week concept and turning it into a live trading room where every night, 5 nights a week, we're in some type of chat room kind of setup, and I'm showing you charts, and we're talking in real time about trade setups and signals and so forth. And again, I've been very pleasantly surprised how many of you are interested in that idea, and I just wanted to thank you for your feedback on that, because I think it's an idea that's very interesting, but I don't know that I would be half as motivated to pursue it if it weren't for the emails that I've been getting in on that subject, and they've been actually surprisingly fairly voluminous. So what's going to happen with that? Well, the good news is I'd really like to pursue it in the future. The bad news is, unfortunately, it's going to have to wait quite a few months. And I'm just being honest here. I just don't want to leave anybody dangling on that idea with any unrealistic expectations. I've got to complete these chart of the week reviews for the MACD course, and we're at number 17 now. There's probably going to be about another, I can't remember how many I'm pledged to do. I think it's a total of 26. The idea was to do a year's worth of these things, which is, in retrospect, a heck of a lot. But anyway, I've pledged to do them. I'm going to do them. It's going to take a while to finish them. There's that. There's these 2 other projects that I referenced that I'm working on. One is a weekly subscription service kind of concept, which is first up, and it's going to take probably a month to get that out the door. And then after that, there's another project, kind of a CD-ROM learning project, not dissimilar in scope to the MACD course, but on an entirely different topic, and that's probably going to take another 2 months. So by the time those 2 things have done, and we've wrapped up the chart of the week, we're probably pretty close to June. And by then, if you have any little kids like I do, they're coming out of school, and everybody's thoughts turn to summer vacation plans and camping trips and out-of-town visitors and all that sort of stuff. And when I get these things done, I'm going to want to take a bit of a break. And then by the time I get around to turning my attention to the trading room concept, realistically, it's probably going to be, I would expect, a good 4 to 6 weeks sort of lead time or prep time to get that up and running. So at this point in time, I would have to say that the earliest I could get a live trading room up would probably be, my best guess at this point would be early September, just realistically. There's just, unfortunately, there's a lot of other things in the way that I have to get done. But I'm really gung-ho for it because, for no other reason, a lot of you folks are expressing interest. Now, that doesn't mean you have to wait on me. There are some excellent other services already available that you could check out. Chris Laurie's got his Pro Traders Club, and Seth Gregory, of course, has got his PM Preview, and I think there's some other products as well, or services that are similar to that. So those guys are excellent, and to be very candid about it, they're more experienced than I am. So you're sure to be satisfied with what they have to offer. And I would suggest that if you're hungry for this type of service, check out what they have to offer in the meantime. And of course, by the time I get around to doing my own, I will do everything in my power to lure you back. But certainly, if you need something like that to help your trading along, there's other alternatives in the meantime. But nonetheless, early September is what I'd be shooting for at this point. And of course, that's predicated on a couple of other issues. First of all, I don't think there will be any problem getting support from Peter and Vic for it. But I also want to make sure that I can identify the appropriate technology that will allow me to do what I want to do, which is to show you guys charts in real time, and we can all sort of, we can trade ideas back and forth in real time on it, share some conversation, answer some questions, and so on and so forth. The power of many minds together, working together, is much greater than that of any one person working alone, so I think that could be pretty exciting. Anyway, a long digression here. That's today's agenda. Let's get down to it. Alright, so here we go. First order of business is to how to basically replicate or fake an SMI if you don't have it. I don't think this is even available on MetaTrader. I don't know. I'm not an experienced MetaTrader user. So I can only show you what I've got on IT Finance, whether it's the free demo or the paid subscription version you use. Now, just incidentally, in preparing for this, I also looked at AccuCharts, and there is an indicator AccuCharts has called Stochastics Momentum Index, but it is very different from what we see here on IT Finance. It is just a single line that kind of bobs and weaves on either side of a single horizontal line. It's not. It doesn't have a signal line built in, and it doesn't have these overbought, oversold thresholds. So I'm not sure, to be honest, what that's really all about. And the other problem I had looking at AccuCharts is that the slow stochastics indicator they've got there does not behave the same way as the one I'm looking at here, and I can't tell you why that would be the case. It doesn't have the same contour. I can't get it to be smoothed out the same way. It just doesn't look the same, and unless I was able to sort of dig into the underlying formula that's used to depict that on the chart, I can't really explain why. So I think I'm going to skip AccuCharts. I was planning to show you both alternatives here, but if I don't understand the other one, I just can't speak intelligently about it. So sorry, any of you hardcore AccuCharts junkies out there. You're just going to have to see if you can replicate this on your own charting platform. But anyway, here we go. I guess I should have prefaced this by saying what I'm responding to here is that I've gotten a fair number of emails from people saying, gee, Frank, like the system, can't get SMI, what do I do? It's not a worry, it's not a problem. SMI is just a derivative of stochastics. It's just an easier to work with version of stochastics, in my opinion. The visual presentation is just it's just a little easier on the eyes. So if you can't get it, don't worry about it. Not a problem. Just use stochastics. It's not a difficulty at all. But what I'm going to show you here is a very specific way you can replicate this indicator. You can see SMI here. It consists of this black line, a leading line. The red dashed line is a signal, and then I've got this funky little color zone thing that I showed you previously. Just makes it a little more a little easier to work with. Kind of purdy too. It's just purdy to look at. Anyway, and then we have also got these reference lines for overbought, oversold. We've got plus 40, minus 40, and then in between here, this dashed line I've just plugged in is a zero line. And that is just the dividing line between positive and negative momentum, which is similar to the water line on MACD. So again, here's how we replicate this if you don't have SMI. I'm just going to go in here to my indicator menu in IT Finance, and I'm going to look for smoothed stochastic. And this is an interesting question. I wonder if anybody out there has the answer. Is smoothed stochastics the same thing as slow stochastics? That might be the issue when looking at AccuCharts, because slow stochastics might be something different. I wish I knew. I don't know, honestly. But smoothed stochastic on IT Finance is what you can use. So if you have something similar to this on your charting platform, just click it open. Now, before we change this up, I just want to show you. You can just compare these two indicators, and you'll see the difference. Just looking at the contour of the line, just with this default setting of 14.35 on smooth stochastics, you can see there's a lot more noise in the signal. It's a lot more jittery. There's a lot more crossovers. Half of them are noise. It's just, yeah, what can you say? It's just a lot more jittery. It's harder to work with. You get all these crossover events and not sure to what to make of them. So there's quite a difference. But what we're going to do is we're going to dress up this indicator to do the same thing. I'm just going to make this as similar as I can. Okay, so the first thing I want to do is I take my smooth stochastics, and I'm going to change the setting from the default 14.35. I'm going to change the period setting to 21, and the second period setting to 5. 3. There we go. No, I didn't do this right. I did it right earlier. Sorry, bear with me half a sec. 21, 21.55. Okay, there we go. 21.55. So you can see right away that changes the contour of the line, and it's now, there's a lot less jitteriness in it, a lot less noise, a lot fewer whipsaws, and if you compare these two guys, they're a lot more similar now, right? You can see they kind of go up and down at the same time. We had a little reversal crossover here, rose up, had a bearish crossover, came down, so on and so forth. So these two lines, they're not identical, but they're pretty darn close now. Pretty darn close. And the next thing what we can do is we can change the overbought oversold thresholds to replicate what's happening on SMI. So I'm going to change it. The default is 2080. I'm going to change it to 7030. And then finally, I'm just going to add in a horizontal line here, and I'm going to put it at 0. Make it a dashed line. Oops, that shouldn't be 0. That should actually be 50. Because again, we're not using the same scale. So now what you can see is, hey presto, is that not almost identical? We've got SMI on the top here, and we've got smooth stochastic with a modified 21.55 setting, and these also modified overbought oversold thresholds. And you tell me, is this not pretty darn similar? That's pretty compelling facsimile in my opinion. See, we got a bearish crossover and overbought here, bullish crossover just on the oversold threshold here, and vice versa. These guys are moving in pretty darn similar fashion. Not always 100% identical. You can see here the SMI is pretty bullish, whereas smooth stochastics is just sort of still bobbing along here. But that's it's a pretty close example, or pretty close facsimile. And in a really good setup like you have back here, we can see back here, this was a nice short setup, even though we wouldn't have taken it per the rules of the Four Sister system, because we weren't actually, we didn't have a bearish stack here. But if we were just basing this on an oscillator with parabolic, you can see these are pretty similar. So that's our first item dealt with, how to replicate an SMI indicator on your charting platform if you can't access it. Just play around with those settings like that, 21.55, maybe adjust the overbought, oversold thresholds, and you'll have something fairly close. Now again, going back to last week's example, pointed out here, this was a very major case of heresy to completely do away with MACD in a course that's about MACD, but what we're going to do is add it back here, and I'm going to show you how we can use MACD as our primary indicator for a setup. And that's all we do. We just plug in the 824.9, and I'm going to look for a really good example of a Four Sisters trade here and see what we might have done. It's kind of hard here. I've got the price action squished up. But here we go. We have a bearish stack, the 800, 400. The 200 and 100 are both painting in green here and kind of curling up a little bit. This could easily be regarded as just a bit of a pullback or a fake out. The stacking effect is still fundamentally bearish, and until these guys start crossing over in earnest, this is still a downtrending market. So you can see here how you could use MACD in place of, or perhaps in addition to SMI if you choose. It's just we do the exact same thing that we profiled last week with this trading system. It's just that instead of looking for an overbought peak reading on SMI, we look for a bearish crossover above the waterline on MACD, and I've got this 824.9 setting here. So you can see. And actually, there's a good cause to use both of these together, because you can see sometimes MACD will help you flag crossover events on SMI that are not 100% reliable. Here we had a very clearly formed overbought bearish crossover in SMI. The trend was still down as per the Four Sisters indicator here. But look where MACD was. It had a bullish crossover event in the background, was trending up, and we didn't even make it as far as the waterline. And this was certainly not kind of a textbook overbought bearish crossover signal here. MACD was still below the waterline, And if we wanted to play it really safe, we should only be selling on crossovers above the waterline, buying on crossovers below the waterline. So even though this was a clear signal on SMI, MACD was not giving us total agreement here. And you can see how if you had gone short, let's see, let's just look at this example right here. The entry price 17.20, and the lowest low we got in the interim before price would have gone back and snapped you out was 16.84. So even there, actually, we would have made our 25 pips. Just another testament to the power of this system based on a 25 pip limit. It almost always works. Even though in the background here we had a swing point, which is a topic I'm going to talk about in just a minute. But nonetheless, we want to take the highest probability trades. And MACD here was not in agreement with SMI. So if you wanted to play it ultra safe, you can use these two indicators together. But here's an example where they're both stacking up the same way. Both kind of in their respective overbought zones. We get a bearish crossover, we get the parabolic flip, and then that was a nice little trade down. And you could have done it, well, again, we're going to stick to the rules and say no on this one, no here, but in fact this thing continued on down further. In which case a trailing stop would have been really nice. As a subject I said we were going to talk about this week, but actually there's these other items to deal with first, so I'm going to come back to alternative exit strategies in the next installment. So anyway, how we use MACD, we can use it as an alternative to SMI, or we can pair it together with SMI just to provide a little extra signal validation. Now I'm going to remove this version of MACD, and I'm going to show you another version of MACD with the so-called zero lag. This is kind of a new and improved, relatively speaking, new and improved take on the traditional indicator, and it's constructed the same way. It's just the mathematical difference between two exponential moving averages. But there's a unique formula that's used on the moving averages, and they call it zero lag. I think that's probably a little bit of an oversell, but certainly in spirit designed to remove a lot of the lag that comes from moving average crossovers. And what's really kind of interesting here, if you stack these two guys together, this zero lag MACD, and by the way, in addition to the subscription version of IT Finance, you can also get this for MetaTrader. I know that for a fact. I've seen people referencing a zero lag MACD for MetaTrader. And what it'll do is it'll tend to give you crossovers more quickly, sooner than the traditional MACD, and furthermore, the overbought, oversold readings will tend to be much more pronounced, which is kind of cool. It makes those entry signals just much more certain. And you can see here, a lot of the times, these two indicators are working pretty closely together. The line doesn't have the same contour, but the crossover events tend to occur pretty closely. Back here on the zero lag MACD, we had a bullish crossover way below the waterline, which is generically oversold right here. And as a matter of fact, it came even sooner than SMI, which didn't flash a signal till over here. So this is kind of a cool little version of MACD. You might want to check out. Just a kind of a new and improved version of it. You can see here we have good bullish signals here and here. The trend was down on the Four Sisters, but here we had nice crossovers on both these indicators. So again, you might want to, you can use the zero lag MACD in place of SMI. It certainly seems to work. Here's an example. Trend is down. Overbought, bearish crossover, parabolic, go short, there you go. And here again, here's the example we just looked at a minute ago, just a real shallow little short. Here's another example, zero lag MACD, bearish crossover, we wait for parabolic to flip. This is kind of a mixed bag reading here, but nonetheless, just for the sake of example, this was a really great short. See if we can find some more good examples. Here's a really lovely one in the background. This is crystal clear. Like if you don't look at this and go, okay, I have to go short, then you need to do a bit more homework here. See this? 800 down, 400 down, 200 down, 100 down, clear angle and separation, all four of them painting in red, which is a bearish signal. The zero lag MACD rises above the water line. It's already crossed bearish in advance of the actual turnover, which is really cool. Then we see parabolic and we go short. This is the candle to go short on at 22.41 on pound Aussie, and you can see if you could have ridden this down to, oh my goodness, 1700. That's 500 pips right there, folks. I know we're only going for 25 pips as a generic limit, but again, next time we look at this, we're going to talk about some different exit strategies that allow you to grab a little bit more of the action. So anyway, again, I just wanted to make sure nobody got kind of an unpleasant feeling that in a course about MACD that we're abandoning MACD. Nothing of the sort. It's a great indicator. It has a lot of different uses, as we've noted thus far. So if you don't like SMI, you can use either the traditional MACD or this zero lag version. And again, if you don't like MACD or want to try something different, just use SMI or smooth stochastic instead. Okay, so let's move on now to the next two topics, which is how to use price filters on the Four Sisters trade. All right, what I want to do next is kind of kill two birds with one stone, so to speak, in terms of using the same price example and finding two different filters to help you filter signals that are offered by the Four Sisters trade setup here. So what I've got showing is a 3-minute chart for pound Aussie, and this is for Friday, February the 15th, right in through to just ahead of the New York Open. And I want to show you a really interesting example of how you could go wrong if you just apply this thing a little too mechanically. So in this example, of course, we have the Four Sisters, or however you want to refer to them, 4 EMAs, doesn't matter to me. But clearly they're stacked bearish, right? We see the 800's bearish. In fact, we had a death cross of the 400 through the 800. Now this thing is totally stacked bearish, no question. If you wanted to be gutsy, you could have gone on a little bit sooner here. This wasn't stacked totally bearish, but it was very clear that this thing was turning over that way. But anyway, just stick to the rules and play this very conservatively. You wouldn't have considered a short before, probably somewhere in this area, and by then already a lot of the action is already water under the bridge, so to speak. But that doesn't matter. If you're just going for 25 pips, it really doesn't matter. We're just trying to do that with an extremely consistent high level of probability. But here's an example of how, last week we said this was a fairly mechanical system, but you can't be 100% mechanical about it. You can't just let indicators. It's a bit of a double-edged sword. You have to trust your indicators, but you can't be so totally indicator-driven that you don't take any of the other information into account. So what we've got here, we've got this downtrend playing out, and now if we happen to be trading at this fairly ungodly hour of 6 in the morning Eastern Standard Time, we're looking at this and going, okay, this is great. This to us looks like a counter trend, a pullback, and it is exactly that. It's counter trend. So with this trend playing out very bearish, and SMI now having gone extremely overbought, generically speaking, we're just sitting and waiting for a chance to go short, right? So what is that? It's basically parabolic flipping from green to red. We're overbought here on SMI. We flipped green to red. So just applying the simplistic rules, we would have gone short here. We should remember this time. I'll almost write it down on a piece of paper or something. 6:36 a.m. on this 3-minute chart gives us permission to go short and try and bag our generic 25 pips. Now, most of the time you can just play it that simply. You can most of the time, but it's a good idea not to just trade off the single time frame. And what we can do to maximize our probabilities is scroll higher to the next higher level time frame and see if the signal there is in agreement. And if it's not, what we should probably do is regard the signal as bogus or at least not well timed, and wait for price to give us a subsequent bearish crossover coming later. So 636, and I've just got this scrolled to the right hand side of the chart, so we're kind of pretending we're trading in the live edge here. 6:36 a.m. on Friday, February 13th, a 3-minute chart says to go short. Now here's a real simple, dead simple technique for validating that signal. Let's again scroll back here. And sorry, just bear with me half a sec. I've got the wrong indicator here. I'm going to put SMI back in. There we go. Okay, and there we go. Okay. All right. Okay, so that timestamp on that 3-minute candle was 6:36. So what we immediately do is that we drill down now to, or drill up, I guess you should say, to our 15-minute chart, the next higher time frame, and just take a generic reading of the momentum indicator on this time frame. 6:30 was the nearest candle we have that's live when we saw that signal, and that puts us right here. Now, what's the thing that you notice? On this time frame, we're not going to pay too much attention to the stacking effect of the moving averages. We're trading that off the 3-minute chart. So here we're just going to ignore this. But what we are going to pay attention to is our SMI, or whatever you're using in its place, zero lag MACD, what have you. And at 6:30, what do we see happening here? Right down here, while we've gone deeply oversold, we have a bullish crossover playing out. And this thing is just reaching for the sky right now. This is extremely bullish angle and separation. And I'll just tell you how I play this thing. What I'm looking for is SMI on the 15-minute chart to rise above the -40 line in the case of this oversold reading down here, to rise above the 40 line. And ideally, I'd like it to rise above the 0 line, in the so-called water line here. And as long as it's kind of done that and achieved anything from a quasi-overbought reading, in other words, a crossover above the 0 line, or preferably above it, like above the overbought line here at +40, then we're okay to go short. But at 6:36, where the 3-minute chart is saying go short, the 15-minute chart is saying no way. We're nowhere, like this is just nowhere near ready for a short signal. We want to see this oscillator rise well above the -40 line, and ideally above the 0 line as well, and most ideally above the +40 line. It doesn't have to satisfy all those conditions, but you have to look at this signal and say, no way. There's just no way this thing is, we're ready for a short. So what do? Well, we drill back down to our 3-minute chart, and we just watch and wait. So parabolic flipped red. We had a bearish crossover. That's fine. We're just not ready to act on this one yet. The 15-minute indicator was not in agreement. So we're just watching price unfold in real time. And if we had sat on our hands through this, we'd at this point be going, darn good thing we did, because look what happened. We had a bit of an up thrust or price rejection wick on this candle at 709. And if we set our parabolic stop right here, it came just far enough to poke that level. So we would have gotten stopped out if we'd gone short early right here at 6:36. So we continue to watch and we wait. The trend is still bearish as per the 4 EMAs here. The price is now rising higher and higher and higher and higher. Ooh, we got a secondary bearish crossover. Okay, now again, we're gonna validate this against the 15-minute chart. The other thing I should point out, if you were really on the ball here, this is a divergence signal. We got a high and a lower high on SMI. We've got a high and a higher high on price. So that's negative divergence. So that's really neat, because that gives us more confidence in the short setup. So what we want to do is we just want to wait. Oops, sorry, hold on here. Wait. Or no, maybe not wait. Let's say this is 7:45. This is clearly a bearish crossover with divergence. So let's just drill back to the 15-minute chart. Again, the timestamp here is 7:45. What's this chart doing? Well, you can see what SMI's done. It's gone way above the 0 line, even though I don't have it plotted in. At 7:45, actually, I'm just going to do that. I'm just going to add that horizontal line. It's just a good reference. There we go. Okay, so did you remember I said earlier we don't want to go short here. We don't want to go short here. We probably don't want to go short anywhere here. But now, in this downtrending market, this SMI has risen above the zero line and is now sort of curling back. In any event, this is as close to an overbought signal as we need to be a bit more confident in what's going on the 3-minute chart. So I'm just waiting now. Oh, we still don't have parabolic flipping. That's okay. This is why parabolic is so great, because it helps us fine-tune our entry points. If we just took it on the basis of a crossover, we would have gone short here, but that's clearly too early, right? So we're waiting. Aha. Here we go, 8:06 a.m. We now have, this is kind of like a 3 kicks at the can, I guess, a three pyramids pattern on the SMI indicator. We have one overbought peak, a secondary one which is lower, a third one which is lower, and an even more elongated divergence. So at this point, I would be happy to go short. And whoops, why didn't that work? Oops. Let's go back to our 15-minute, 8:06. Well, we're just crossing the zero line, still bullish angle and separation. That's why that one didn't work. Then we get another parabolic flip at 8:45. And by this point, you can see now the SMI on the 15-minute chart is only now starting to flip over. It's only now starting to curl over towards a bearish crossover. So you can see here, that's why you want to be very careful with these guys. You can't just apply them indiscriminately and say, okay, bearish stack, overbought, parabolic flips, I'm going in, because you can see here we had 1, 2. It wasn't until we got the third event here before we were safe to go short. And from here on down, it was a very safe trade. But even here, at 8 o'clock, it wasn't safe. At 8 o'clock on the 15-minute chart, we were just breaking above that zero line, and it was still pretty bullish angle and separation. So you just got to wait. And sometimes, you do have to guess a little bit. Is this the event where we're going to see a turnover on the 15-minute chart? You can never be 100% certain, but you should definitely be patient. Don't rush into this. So this is just one filtering technique or validation technique. We were kind of pointing to the fact that this was kind of a single time frame kind of trading system, which can be a little bit dangerous, but there's no reason at all why you can't use at least one higher level time frame to validate these signals. So that's what you do. You look at your 15-minute SMI or whatever oscillator you're using, and it doesn't have to be in perfect agreement, but if it's trending in the opposite direction with clear angle and separation, you definitely want to just rein in your trigger figure a little bit and not be in quite such a hurry to rush into the trade. So that's one technique we can use. I'll show you another one here, and I'm just going to keep this page up because what we're going to do is we're just going to use the exact same price data. Now, an even more effective technique for filtering these, another reason why you wouldn't have wanted to jump on this as a short just yet, pertains to the presence of swing points and retracements and Fibonacci and that whole ball of wax, so to speak. Here at 6:36 a.m., what do we see in the background? Well, we had a fairly clear swing point. If we were looking at the 15-minute chart around here, which is 5:48, even clearer, right? On the 15-minute chart, this was a hammer coming at the end of a pretty sharp run down in price. A swing point, and price had bounced off this support level and was now moving in the opposite direction with a lot of gusto here. Now what we want to do is we always want to be cautious of swing points, and we want to be aware of the potential for retracements. So if you were just coming into the market here for whatever reason at this ungodly hour of 5 in the morning or 5:30, you got to take a look at price action. What has it done? Well, we've had a pretty handy collapse here from a level of about 1833 to about 1561. So, that's 270 pips right there. You don't want to sell at the bottom of a run down in price. You don't want to buy at the end of a sharp rally, right? You know, this thing has collapsed nicely, but it's not going to keep going forever. We know that price tends to unfold in waves. We have one wave of progress, one wave of regress, a second wave of progress, a second wave of regress, and so on and so forth. That's the core underlying principle right there of Elliott wave theory. So, you know, you saw that price collapsed. There was a swing point here. Support was found. It bounced off there. So you got to ask yourself what's going to happen next. The surest way to kind of gauge this whole thing is to pull out your handy dandy Fibonacci. Now, this is going to tell us that this is going to confirm for us that we have a retracement underway. And so what you want to do, like the 3-minute chart is pretty spread out. You'll want to compress it pretty much like I've done here, so you can just more easily identify the swing point. So the swing point we were looking at in the background was right here, and we want to connect it back to a previous swing high, and that would have probably come right back here. So I'm just going to join those two guys. So you can see I have an A and a B. And so when I was looking at, now let's decompress this again. Do you remember how at 636 we saw this, the trend was still down, we were overbought on SMI, and we had parabolic flip here, but we concluded later that that was an invalid signal. From a Fibonacci point of view, the reason why it was invalid is because right from this swing low here, price was in a retracement. This was a retracement mode. Now, by the time price had gotten to here, had it completed, clearly completed a retracement? How far had it gotten? Well, it had gotten somewhere between 0 and 38.2, but we had not clearly found resistance on one of these pivots. Okay, this is not a daily pivot, this is a Fibonacci pivot. These horizontal lines are all pivots. They're support and resistance, whether it's a daily pivot or a Fibonacci. But you can see here, if you'd plotted this Fibonacci, there's no way in heck you'd feel comfortable going short yet, because you want to see the retracement run its course, right? You had an A in the background, you have a B. You want to have a clear C point emerge, which you can confirm on one of these Fibonacci levels. And by the time price had gotten here, this just wasn't cutting it. Like, this was not a retracement that had clearly run its course yet, even though the trend was down, and the indicators were lining up the proper way for a short. But we can see what happened here if you just, again, sat on your hands, don't do anything until you have a C point. We have a little bit of congestion here around the 38. And in fact, this was a little bit tricky because, you know, you might have looked at this and said, okay, this is resistance at the 38, even though price had closed above. So this might have just been one of those unfortunate scenarios where in the live edge of trading this might have looked like a retracement, but it wasn't. I always tend to prefer to see price to go up to the 50 or the 61.8. But in any event, like we just showed you a minute ago, it didn't matter because you could still be validating this against the 15-minute oscillator, and at 8 o'clock it wasn't really a loaf of bread that was ready to come out of the oven yet. It was still trending in the opposite direction. So you can see how you can marry those two concepts together. Look at the next higher time frame, the oscillator reading to validate, and you can combine that with readings against the Fibonacci. So where we got the real bona fide reversal here, we had, this was actually a nice candlestick reversal pattern too. This was a pretty classic Steve Nissen evening star candle pattern here, and look where the price rejection wick went to, right to the 50% Fibonacci right here. So yes, it is easy for me to say this all in hindsight, but I'm just trying to point out how you can use Fibonacci and resistance and retracements to help you time your entry better and validate signals. This was not a valid short because we had not finished a retracement. This almost was, but the next higher level oscillator was still bullish. By here, by 8:45, we had comfort because this really did have the look of a retracement that was finished, right? We rallied up to the 50% counter trend direction, an evening star reversal candle pattern, and again by 8:45 we could have looked here on the 15-minute chart, and by 8:45 this thing was it looked a lot more ready to turn over in the bearish direction than the earlier signals, which were, down here. We wouldn't have wanted to go short with this thing down here. Okay, so I hope that's fairly self-explanatory. Be on the lookout for a sharp move in price, whether up or down, culminating in some type of reversal candle, price finding support or resistance, and it doesn't even matter what that support or resistance is. You would have no choice but to look at this and said, okay, price bounced off this level. Now, how far does it have to continue its bounce before we're ready to get back in line with the trend here? The trend was still down, but you wouldn't have wanted to go short here or here, because the retracement wasn't finished and the 15-minute oscillator was still strongly poised in the counter trend direction. But by the time we got here, very safe trade, virtually no drawdown at all, 25 pips in no time. As a matter of fact, with an entry price, let's just find out here, 1654, we could have gone as low as 1595. So, about 50 pips, double what we're looking for. And as a matter of fact, this thing after that continued heading on down much, much further even. So there we have it. A couple of filters. I was just a little bit, worried over the weekend thinking about this thing. The way I presented this on Thursday last week, I didn't want to make it seem like, you could just mindlessly take a few signals on the 3-minute chart and always be guaranteed a profitable trade. You can't. You can't be totally mindless. Apply it mechanically, but do that judiciously. These signals won't always work if you just apply them without any kind of context. And Fibonacci's are always useful, very useful to flag retracements, and then again, higher level oscillation readings are also useful. There we go, folks. That's the end of this installment of Chart of the Week. Certainly a lot more kind of textbooky, a lot more theory-oriented than previous examples, but I thought it would be worthwhile to provide those additional refinements to the Four Sisters trading system just to help you maximize your opportunities, time your entries better, and so forth. Avoid being stopped out as much as humanly possible. So here's a recap of what we looked at this week. If you can't get SMI on your charting platform, you can use a slow stochastics with the 2155 setting and just tweak your threshold levels from 2080 to 7030, and it's virtually the same thing as SMI. And we're not giving up on MACD, not at all. You can use MACD in place of or alongside of SMI. You can use either a traditional MACD with the 8249 setting or the new and improved zero lag version of MACD, and either of those works just fine to help you get your entry signals in line with the trend. To time our entry signals optimally, it's a good idea to consult at least one time frame. We saw how a 15-minute SMI that was trending in the exact opposite direction from which we wanted to go on the 3-minute chart really helped keep us out of the trade, prevented us from taking signals that were too early. And finally, on the same chart example, we looked at how swing points and retracements and the use of the Fibonacci can help us identify when it's not really a good time to enter the market. When price has already moved substantially, hit a swing point, is in retracement mode, we can occasionally get some bogus signals, even though they're lining up with the trend depicted by the 4 moving averages. So those two things are really good filters to use. This probably seems like a lot of information being thrown at you just when I finished telling you last week the Four Sisters trade is very simple, but if you just practice this and just keep that information handy, you'll learn it. It's still a very simple trading system. It's just you want to make sure that you're not in an overly mechanical, overly dumbed down approach, just applying the signals. You have to consider the context of price action. So there we have it. Those are the refinements that I have to offer. I don't really know what else I can say about this trading system. It is simple. There's not much else you really need to master to do well with it. Like I say, next time around we're probably going to look at a couple of different exit strategies that help you bag more than just the generic 25 pips, if that's an important issue. So that's it for this week. Well, maybe not this week. I hope. I'm going to cross my fingers and see if I can actually get some time for some trading examples later. If I can free myself from some of my other items on my to-do list. So if I don't get the chance, I will definitely try to make up for it next week, see if I can crank out 2 of these next week. So in the meantime, thanks for your patience, and like I say, I'll try my very best. There's a cryptic hidden message in here. I hope you can see it. This is going to test your pattern recognition. But anyway, thanks for your support. Thanks for your ongoing correspondence, and we'll talk to you soon. Bye now.